In Investing 101 today, we are turning to Craig Bolanos. He's the CEO of Wealth Management Group. Good to have you on our show
Yeah, thanks for having me back, huh?
Why should investors even be concerned about corporate earnings?
Well, I don't know about you, but I invest to make profits, to make money, and there is no bigger predictor of stock price performance over the near and long term than a company's earnings per share and outlook. So that says it all.
When you take a look at what an analyst is saying, say an analyst is talking all about Microsoft, and they're getting into the nitty-gritty of what's going on with the company.
Yeah.
What do you like to look for?
Well, the first thing I'm looking for, if we're talking about Mr. Softy or any company, I'm not just looking at earnings per share, I'm looking at revenue, because a good leadership team can massage the earnings and make them look good, but there's something you can't massage. You can't fake top-line revenue, aka how many services are you rendering and getting paid for, and how much cost of good, how many goods are getting sold.
How do you feel about investing in companies that have big revenues and are continuing to beat the street, while we have some hot IPOs that are performing very well in the stock market, but yet are losing money or heavily in debt?
It's interesting at this stage in the market cycle. I think, what happens is growth is always a good story. You need to invest for growth, especially if you believe the economy is going to be slowing down, aka slower growth for longer. But there's something really interesting that's happening, which is you have these companies with high-flying PEs that aren't necessarily seeing their stock prices rewarded like they once were. So I think investors should be mindful when they look at their portfolio today, not to pay up too much for growth, but really make sure the size of that P, the price, justifies the size of the E, the earnings, in that PE ratio.
What about scooping up stocks when they're down? Sometimes a company can come in and have a poor earnings report, and boy, investors can really take that stock right down.
Well, you know what? The stock market moves faster than it ever has. The stock market is just more efficient than it's ever been, and things get weighed so quickly. But there's an old adage. New highs make new highs. There's nothing wrong with buying companies that are constantly breaking new highs. But when you see companies have these big one-offers, this big earnings miss, which sometimes a big miss is they're off by a penny or two in their outlook, that just might be an overreaction from the market. And if those companies are on your shopping list, it might be an ideal time to start scaling in.
What about your common sense advice here? Do you tend to go with what you know, corporations that you like, products that you enjoy?
Well, you know what? When people ask, I want to get away from just the core of my portfolio, dirt cheap, low cost index funds. I want to move beyond the mutual funds in my 401k plan. Yes, I say let's look at our surroundings, look at the sphere of our everyday life. And you can just say, gee, what's that phone in my pocket and who makes it? And what network is that phone being carried on? And I ask you, name one bill that's totally overpriced and over costly every single month that you can't live without. You probably know what it is. It's your cable and internet data provider. Those just might be great investments. So yes, I agree wholeheartedly. Let's begin by looking at things we know and consume every day.
As far as other ideas, do you tend to stay diversified because you need more than just corporations in that portfolio?
Well, you know what? That gets down to matching your time frame to your investments. And something people sometimes get wrong is, should we be saving or should we be investing? If I'm looking to purchase a new home in the next 1 to 3 years, I'm using a high yield savings account. But if I'm planning for my kids' college education, if I'm planning for my future retirement, that's going to be long-term investing all towards stocks. But what do you do when you start getting close to the transition, aka I'm on the cusp of retirement? You absolutely need to diversify beyond stocks. You need to start bringing in additional asset classes, whether it's fixed income, various forms of bonds, whether it's real estate investment trusts, whether it's energy distribution companies. You need to broaden the spectrum to make sure you have a diverse line of revenue streams, because you can't afford to take a financial hit on the cusp of retirement.
Well, you are a wealth of information, so thanks so much for being on our show today.
Yeah, thank you.
We hope to have you back.
Wonderful.
For more Business First AM, check us out on social media. We're on Facebook, YouTube, and Twitter. And go to businessfirstam.com for where to see our show on TV.